Well, what a roller coaster of a first half. We saw the markets rally strongly in January and February. They then went to sleep and then, having decided what to do, sold off in May. The issues that led to that May sell-off, unfortunately, are still intact. Now, the first of these is Europe. And underlying the European problems is the fact that the European governments are very heavily indebted. So that if we do get a Greece default, if we do get a Spain default, it's going to hurt, it's going to cost. And as you can see on the chart, the level of indebtedness today as a percentage of the overall size of the economy is still well above the 10-year average. But what hasn't really been discussed and has slipped off the radar is another European problem, and that's this one. For every $100 of deposits, the European banks have lent $135, which means they've had to borrow another $35. And so a lot of the measures that the European governments have brought into play have been to support the banks so that they can continue lending, but it hasn't solved the issue. So the European problems are very fundamental, and they're going to continue for some time yet. The second issue is slower growth in the US. Now, we think that subprime growth, that slow growth in the US is the most likely case. But when you look at the economic growth figures that the government releases, you can see that where the concern comes from. Growth definitely has slowed. But unfortunately, the headline figures pick up a number of swing factors. Government spending, for example, which we all know that the Americans are trying to reduce. Company inventory levels can be a huge swing factor as they build up and run down their stockpiles of finished goods. So if we remove that factor, suddenly we get a different picture. And the underlying growth in the States, while not strong, is certainly not down and out. Now, there's other good news out there despite the soft economic data that we're seeing. And probably one of the most fundamental is this one. American households have reduced the level of debt significantly. We all know it's been very, very painful, but as you can see, household debt servicing levels are now back to where they were many, many years ago. And that's a good sign. So overall, it seems to us that the US is on a track to recovery. It is healing, but investors want to see. They want to see it before they do anything. So again, that could undermine confidence in the next couple of months. The final factor, of course, is China. And here we've got both the bear and the bull case. Now, the bear case is encapsulated by the leading indicator from the private sector, the HSBC market leading indicator, which, as the line shows, is below 50%. Now, that indicates a slow economic economy. Until recently, the bull case was painted by the leading indicator that the government produces, and that was rising very strongly, well above 50%, until last month when it took a dive, as you can see. And naturally, this has caused concern in the market. Now, the last time that economic growth slowed was in 2008, and that was very severe, as you can see. The government's response was to inject huge amounts of money into the system, and it looks as though they're about to start to do the same thing, but not to the same extent. What worries investors is not just the slowing growth, but the fact that the fallout and the excesses of that last injection of capital still haven't worked their way through the system. Yes, inflation is falling, but the property bubble is still there. Local government authorities have gone up to their eyeballs in debt. These have still got to play their way out. So again, while we think that China looks to be in a good position and it will have a soft economic landing, investors are wanting to wait and see. So we're living in a wait and see world. But when investors draw back on macroeconomic fears, as they've been doing, leading to that volatility, they can throw up great value. And that's what is happening in Asia. Because if you look at Asian equity valuations today, they are looking very attractive indeed. They could get more attractive, but equally on a little bit of good news, they could rally very strongly. Equally, if we look at Asian bonds and Asian high yield bonds, they're not as cheap as they were several months ago. They've been caught off in the sell-offs, but they're certainly significantly better value than they were before the crisis began. So that's the weather forecast. For the coming 6 months, it looks as though we're going to continue to see continued volatility for the reasons mentioned, but at the same time, there's tremendous value out there. And so the question as investors going forward that we should be asking ourselves is, how do we play this situation?